we want to start this topic of cash flow statement. I've combined, it's a topic that is found both in financial reporting of the intermediate level, and it's also found in the advanced financial reporting. So I want to remind you, before we go into the details of cash flows, I want to remind you about cash flow. You must have also done it at the beginner's level, which is at the foundation level, or what we call financial accounting. Let me remind you the key issues which are still applicable when you are doing a question on cash flow, whether it's at the intermediate level or at the advanced level. You still need this information. Good. Now, you all know that when you are required to prepare a cash flow statement, you are required to classify. You are required to classify your cash flows into three categories. Classify your cash flows into three categories. The first category is what we call the cash flows from operating activities. That's the first category. The second category is the cash flows from investing activities. And the third category is the cash flows from financing activities. So you normally have to start with by disclosing what are your cash flows as a company, what were your cash flows from operating activities. You have to identify your cash flows from operating activities. Whatever the operating cash flows were, identify them. Once you identify all the cash flows from operating activities, of course, some will be positive, some will be negative, whatever they are. Some will be positive, some will be negative. Get the net of all of them. Get the net of all of them. And whatever you get as the net of all the cash flows from operating activities, you normally have to push that amount to the extreme. That amount can either be a positive or it can be a negative. It can be a positive or a negative. If it is a positive, then we normally call it net cash inflow. It's a net cash inflow from operating activities. Net cash inflow from operating activities, if it's a positive amount. If it's a negative, you remember, you used to call it net cash outflow. If it's a negative, net cash outflow from operating activities. So that's always the first category. You identify all the cash flows from your business that are from the operating activities. Good. Some I said will be positive, some will be negative. Get the overall net of all of them, push that amount to the extreme, and if it's a positive, call it net cash inflow. If it's a negative, call it net cash outflow from operating activities. Then you go to the second category, and that's what we are calling cash flows from investing activities. You have to again identify as a company what are your cash flows from investing activities. What are your cash flows from investing activities? Whatever the cash flows you will identify from investing activities, identify them again. Some again will be positive, some will be negative, whichever the case might be. Once you get the cash flows from investing activities, again, get the net of all of them. Get the net of all of them. Again, whatever is the net of all of them, push that amount to the extreme. Push that amount to the extreme. It could be positive or it could be negative. Let me assume for now that your net amount was a negative. If it's a negative, then you will call it net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activity. That's our second category of the cash flows. That's the second category of the cash flows. Then you go to the third category now, and that is what we used to call cash flows from financing activities. Cash flows from financing activities. Okay? Cash flows from financing activities. Again, identify all your cash flows from financing activities, some positive, some negative, whatever the case might be. Whatever the case might be, identify them. Get the net of all of them. Get the net of all of them. And whatever you get as the net, push it to the extreme. Push it to the extreme. Let me assume again that this time you are getting a positive net amount, a positive net amount. If you get a positive net amount, then you will call it again net cash inflow. Net cash inflow from financing activities. Net cash inflow from financing activities. Okay? After you have identified, listen, after you have identified the three categories of the cash flows, that is the cash flow from operating, the cash flow from investing, and the cash flow from financing activities, then get the total of those three figures. The operating amount, net, the investing, and the financing. Get the net of the three figures. Whatever is the total of those three figures. Whatever is the total again, that can be positive or it can be a negative. It can be a positive amount or a negative amount. If it's a positive amount, I hope you do remember, you used to call it increase in cash and cash equivalent. Increase in cash and cash equivalent. If it was a positive, that's what you used to call it. Increase in cash and cash equivalent. Okay? Then from there you had to add what you used to call opening cash and cash equivalent. Opening cash and cash equivalent, whatever it is. Remember, listen, any question the examiner gave you for cash flow, he had always to give you an income statement for the current year and two balance sheets, or what we can call statement of financial position. One balance sheet for last year and one for this year. So when you are adding here, down here, when you are adding opening cash and cash equivalent, it is that you go to the balance sheet for last year. Whatever was the closing cash and cash equivalent last year, automatically that became or becomes the opening cash and cash equivalent this year. Okay? Then once you add those two, you've taken the increase in cash and cash equivalent, you have added the opening cash and cash equivalent, you get what we call the closing cash and cash equivalent. The closing cash and cash equivalent. Good. Now, whatever is the closing cash and cash equivalent down here, whatever is the closing cash and cash equivalent, that should be the same. Whatever amount you're getting down there should be the same as the amount is the balance sheet for this year. If you go to the balance sheet of this year, how much is the closing cash and cash equivalent? Whatever it's given there should be the same amount you have got here, because you are supposed to reconcile the two balances, the last year's balance of cash and cash equivalent and this year. So when I add the opening cash and cash equivalent, I should get the same amount, which is the same as the closing cash and cash equivalent. Now listen. So this is an overview. This is an overview of how you used to prepare a cash flow statement. Now, we want to go back into the details now and look at how did you identify what you call the cash flows from operating activities, investing activities, and so on. Okay? Now, we need to ask ourselves first, or to remind ourselves, when we say we are looking for cash flows from operating activities, what kind of activities are these? What kind of activities are these? Now listen, when we say we are looking for cash flows from operating activities are those transactions and events, that are used in the determination of profit. Any transaction and event that is used in the determination of profit, that transaction is referred to as an operating activity. Any transaction that is used in the determination of profit, that transaction is known as operating. Now, meaning, if I prepare my income statement, let me assume I prepare my P&L account in a T format. Profit and loss here. You know, we normally debit P&L account with all the expenditures and expenses. Okay. We normally credit P&L account down here on the credit side with any incomes and any gains. With any incomes and any gains. Now listen. Then you normally compare the credit side with the debit side and you get what we call the net profit. We can just call it profit before tax. We can just call it profit before tax. Okay. Now listen carefully. Let me assume you got a profit before tax of 100 million here. Now, it means therefore, listen carefully. It means therefore that if everything in the P&L account was by cash, if everything in the income statement was by cash, that means all the expenses and all the gains and the revenues, if they were by cash, then it implies that this 100 million represents the net cash inflow from operating activities. I have said, what are operating activities? I have said operating activities are those transactions that are used in the determination of profit. Those transactions that are used in the determination of profit are the ones we call operating activities. Now listen. I also said, if everything in the income statement, either on the debit or on the credit, was by cash, then it is reasonable to presume, therefore, that whatever you got as your profit before tax, that represents your net cash flow from operating. But the question is this: is it true, therefore, that 100 million is the true net cash inflow from operating activities? The answer is no. The answer is no. That whatever you normally get as your profit before tax, it is not the true profit or is not the true cash flow from operating activities in net terms. No. So we want to determine. So to determine the cash flows from operating activities, you normally have to take whatever you got as your profit before tax, get what you got as your profit before tax, which for my case, I'm assuming to be 100 million. Then you ask yourself, listen, are there things me as a company I could have debited in my P&L account which are not cash items? Are there things that I could have debited in the P&L account yet I never paid cash for them? Are there yes items? Yes. You also ask yourself, are there things you could have credited your P&L account with and yet you never received any cash for them? Yes. So what we want to do now is to take this 100 million profit and adjust it with the few items that are normally in the income statement, which are non-cash items, so that we adjust, so that we ask ourselves, this item that I took to the P&L account, and it's not a P&L item, it's not a cash item, sorry. What effect did it have on my profit? If it made my profit more than it should be, then I deduct so that I get the true profit if everything was by cash. So what we are trying to do, don't forget, I've said operating activities are those transactions and events that are used in the determination of what? Of profit. Those transactions and events that are used in the determination of profit, they are the ones we are classifying as operating. So I also said, if everything in the income statement was by cash, then whatever you got as your profit before tax, should therefore by implication be the net cash inflow from operating. But I've said it's not always true that it is the net cash inflow. Why? Because of the non-cash items that could have gone to the P&L account. Let me just give you one example. For example, whenever you prepare P&L account, you normally debit your profit and loss account with an expense called depreciation. Is it a cash item? The answer is no. Is it a cash item? The answer is no. You only debit P&L account with expense called depreciation. It's an accounting rule. It's an expense. So you debit the P&L account. But we are looking for, listen to this now, we are looking for the true profit if everything was by cash. If everything in the P&L account was by cash, what would have been the true profit? So we will argue by saying, suppose the depreciation charge was not in the income statement. Would my profit have been more than 100 million or less than 100 million? That's what we want to do. By including depreciation in the income statement, listen, from the cash point of view, it means my expenses were overcasted. I'm not saying it was wrong to debit P&L account with the depreciation, no. But I'm saying from the cash point of view, by us including depreciation in the income statement, then it means my expenses are overcasted. And whenever expenses are overcasted, automatically profit is undercasted. So you will take your profit before tax and adjust it with all the non-cash items. One of them being depreciation charge. Whatever it is, you will argue by saying expenses were overcasted. When expenses are overcasted, profit is undercasted. So to correct it, you add. To correct it, you will add. Okay? Good. Then you look for another item. You look for another item that could have gone to the P&L account. I'm not saying an expense. Any item. It could be you debited P&L account or you could credit P&L account, but you did that with a non-cash item. So what are the other non-cash items other than depreciation? Now let me ask you a question. Other than depreciation, give me other examples of non-cash expenses that could have gone to the P&L account. Chat and give me another example of a non-cash item. You know, I have said we are reviewing the topic. You must have done this in the foundation level at the beginners. When you did financial accounting, you must have also done cash flow. So remind me another example of a non-cash item. Please chat and give me another example. Chat and give me another example of a non-cash item. Chat and give me another example of a non-cash expense. Something you could have debited in the P&L account, which is a non-cash item. I'm also saying, let me also put it this way. I am not saying remember this from your knowledge of cash flow. You can remember this even from your knowledge of accounting. You have done accounting before, so you know how to prepare. An income statement. Something that you could have charged in the income statement which you never paid cash for. Somebody chat and give me an example. Chat and give me an example of another non-cash item. Something you could have debited in the P&L account or you could have credited in the P&L account, yet no cash was involved. Yes, somebody? Other than depreciation. Other than depreciation, you chat and give me another example. Chat and give me another example. Other than depreciation. Yes, somebody? I'm waiting. Deferred tax, we have a place for it. Deferred tax, we have a place for it. Another non-cash item. another non-cash item, disposal of an asset. Okay, disposal of an asset. Sawa. I hope you are not meaning, listen, I hope you are not meaning the cash you received. No. When you sell an asset, let me assume you had an asset which had a net book value of 10 million. If you sold that asset for cash of 8 million, you must have made a loss. You must have made a loss of how much? 2 million. That loss of 2 million is not what you received. That loss of 2 million is not what you received. It is something you debited the P&L account with, yet no cash was received. What you received is 8 million cash when you sold the asset. But the loss of 2 million, you took it to the P&L account. Is it involving cash? No. It means, therefore, from the cash point of view, my expenses are overcasted. My expenses are overcasted. So if there is any loss on disposal, that should be added back, because my expenses are overcasted. When expenses are overcasted, profit is undercasted. Now, to use the same, let me assume now you sold that motor vehicle now for 12 million. It had a book value of 10, but you sold it for 12 million. You must have made a gain of 2 million. You must have made a gain of 2 million. That gain of 2 million, you took it to the P&L account on the credit. That is the gain on disposal. Gain on disposal, you took it to the P&L account as a gain on the credit of the P&L account. But is it an amount you received? No. What you received is 12 million, and that is what went to the cash account. But you took to the P&L account a gain on disposal of 2 million. So if there is a gain on disposal, it's not something you received, yet you credited P&L account. Listen, so we want to ask ourselves, what effect did it have? What effect did it have on my income statement, on my profit? Sorry, what effect did that gain on disposal have on my profit from the cash point of view? It made my profit more than it should be. It made my profit more than it should be. So to correct it, I minus. So I come and say a gain on disposal. Gain on disposal. Whatever it is, you minus. Good. Somebody has given us another one. Somebody has given me another one. And that is amortization. Correct. Just like depreciation, when you amortize, just like depreciation, when you amortize when you amortize an intangible asset, maybe it is a copyright or trademark or any other intangible assets. Whenever you depreciate intangible assets, we call it amortization. Okay, so when you debited P&L account with that amortization of an intangible asset, then again that's a non-cash expense. So it made your expenses more than it should be. When expenses are overcasted, profit is undercasted. Profit is undercasted, so you come and add it. That is amortization. You come and add it. That is amortization. Good. Amortization. Good. Somebody has given me another one. That is finance cost. That one is what I want to talk about in details. Just to remind you, let me discuss it separately first. Let me discuss it separately by asking you a question. Somebody has given me finance cost. In your financial accounting, if you remember, you did a topic called company accounts. And in that topic of company accounts, you were given a trial balance. And in that trial balance, for example, you could have been given a 10% debenture. And in that trial balance, let us assume the debentures were worth 500,000. The debentures were worth 500,000. Now listen, in that trial balance, you have something like interest on debenture. Interest on debenture, let's assume 40,000. Then from there, assuming that's all, then you are being required, listen, you are being required to prepare an income statement or P&L account. My question to you is this. If you are given a trial balance of this nature and you are told to prepare an income statement, that means P&L account, tell me this, how much were you charging? Because I'm reminding you, how much were you charging in the income statement as interest? Look at that trial balance, and tell me, if you are given a trial balance of that nature, how much will you charge in the income statement as interest? This is something you did in company accounts. Tell me, how much would you charge in the income statement as interest? How much would you charge in the income statement as interest? Yes. Look at that trial balance and remind me, how much were you charging as interest in the income statement? How much were you charging in the income statement as interest? Look at that trial balance and tell me, how much would you charge as interest? In other words, let us say, how much would you charge as interest in the income statement? Yes, somebody? I'm waiting. How much would you charge as interest in the trial balance? I'm waiting. Benedict says 50. Benedict says 50. Let me hear some more opinion. Benedict says 50. One more opinion. How much would you charge as interest? When you are given a trial balance of this nature, how much were you charging as interest? Benedict says 50. Somebody else? One more opinion. I'm not saying Benedict is wrong. It could be you agree with him or you're disagreeing with him. Fine. But let me hear one more opinion. You must have done company accounts before. One more opinion. Please, one more opinion. I'm not saying the person who was given us is wrong. I'm not saying the person is right. I just want to see one more opinion. Don't fear. Okay, 2 people are saying 50. That's correct. Now listen. That's true. 50. Now listen. Whenever you are preparing an income statement or a profit and loss account of a company or even any business, it does not matter whether it's a partnership or a sole trader or a company, it doesn't matter. Whenever you are preparing financial statements, we normally follow a concept we call accrual concept. We normally follow a concept called accrual concept. That concept states that as a company, you should recognize costs when they are incurred. You recognize costs when they are incurred, but not when money is paid. You recognize cost when it is incurred, but not when money is paid. So, by looking at this trial balance, this company has a 10% debenture. Every year, they are supposed to pay their debenture holders an interest at the rate of 10%. 10% of 500,000, it means every year they're supposed to pay their debenture holders interest of how much? 50. That's what they're supposed to pay. So whether they have paid it or not, the concept states recognize cost when it is incurred, but not when money is paid. In your income statement, you will charge 50,000. Listen, when you will be preparing the balance sheet of this company now, when you'll be preparing the balance sheet of this company, that's when you normally have to ask yourself, as a company, do we owe the debenture holders anything for interest? Do we owe them anything for interest? So you go back now to the trial balance and realize, oh, we have paid them 40. We were supposed to pay them 50, but we have only paid them 40. So we owe them another 10 million or 10,000 for their interest. It is that 10,000 that you normally take to the balance sheet as a current liability among the interest owing of 10,000. That's how you used to prepare an income statement and a balance sheet if you are given a trial balance of this nature. Now listen. Suppose in the trial balance there was no interest. Suppose in the trial balance there was no interest. Listen. Would you still charge interest in the trial balance, in the income statement? Assuming in the trial balance there was just a 10% debenture and there was no interest in that trial balance, would you still charge interest in the income statement? The answer is yes. You will still charge interest in the P&L account. Why? Because we have said you follow the concept of accrual concept. Whether you have paid it or not, you recognize cost when it is incurred, but not when it is paid. So whether we have paid it or not, we just know we were supposed to pay 50. We have not even paid anything, but that does not mean I don't recognize an expense called interest. I still recognize interest. Then when I go to the balance sheet now, that's when I ask myself from the trial balance, have we paid anything? The answer is no. We have paid nothing. So the whole 50 becomes the charge for the year, and the whole 50 becomes the liability for the year. Are you there? Good. So let me go back to the first scenario where we had paid part of it, where we had paid part of the 50, which is 40. Now listen. So now I'm trying to answer Joyce. Joyce is the one who gave us another non-cash item called finance cost. So this interest of 50, which we also consider as a finance cost, listen, that 50 is not something we paid. It's just a bookkeeping entry. How did we get it? We just took 10% of 500 and we got the amount of 50. So that is just a bookkeeping entry. It's a non-cash item. So among the non-cash item that went to the P&L account, again, is another one we are now getting as a finance cost. As a finance cost now. Here, this is finance cost of 50. Listen. But you remember, we had only paid 40. Listen. That 40 that we had paid will normally go to the cash flow statement among the financing activities. Down here, where we were showing the cash flows from financing activities, there we shall have interest paid. That is the actual cash paid. It's a financing activity. Don't forget, you borrowed from debenture holders. You borrowed to finance your business from the debenture holders. Okay? Then when you pay interest on the financiers, then we normally say any returns you are paying to the financiers, that is a financing activity. So that 40 we paid, you will take it to the cash flow as a financing activity. The whatever you paid will take to the cash flow as a financing activity. I hope that point is clear, that it's only what you paid that goes to the cash flow under financing. But what you charged in the income statement, being the charge for the year, that will be a non-cash item. That is the 50. We are using 50 as our example. That is the charge for the year. I hope you have got it. In the second scenario, listen, in the second scenario where we paid nothing, I still will bring in a non-cash item of 50, but listen, but in your cash flow statement down there, will you now have something called interest paid? The answer is no. Why? Because you had paid nothing. You had paid nothing. So there is nothing you will take to your cash flow as a financing activity, Good. That's all for that. So let's move on to another item. We are still trying to identify non-cash items. We have identified depreciation. We have identified gain or loss on disposal. We have identified amortization. Then we have also identified this finance cost. We have so many others. Let me give you a few more. Let me give you a few other non-cash items. Like, for example, you may have what we call provision for bad debts. Listen, when you anticipate that some of your debtors are likely not to pay you, it is required that you make a provision for bad debts. You provide for bad debts. That means you anticipate that loss by providing for it. Is it something you paid? The answer is no. But you made a provision in your books. That provision for bad debts, being another non-cash item, will also be used here as a non-cash item. This is provision for bad debts. Provision for bad debts. Whatever it is, you debited P&L account with whatever anticipated loss you expected. So that is another loss. Another example could be bad debts. Also the bad debts. When you write off a data, as a bad data, remember, you did not pay that amount. You went to the debtors account, you credited debtors, and you debited the account called bad debts. Whenever you are to write off a data, you credit data, you debit bad debts. Then by the end of the year, you normally take the balance of the bad debts to the P&L account as a loss. But there was no cash involved in that amount called bad debts. No. So again, it's another non-cash item. Good. Another example could be impairment. Maybe you are impairing your goodwill. You have goodwill impaired. So if there was any impairment of goodwill, that again is another non-cash item. Okay, good. Now, let me assume for now, those are the non-cash items that you have identified. Once you identify those non-cash items, get the net of them. We have agreed, some are positive, some are negative. Get the net of them, whatever it is. That amount you get, we normally call it cash flow before working capital changes. We normally call it cash flow before working capital changes. Then you now bring in the working capital items now. You now bring in the working capital items. I have already told you before, a few minutes ago, that whenever you are given a question of cash flow, the examiner will give you one balance sheet for last year and another balance sheet for this year. Okay? So you go to the balance sheet last year and this year and analyze the working capital items. That's what we are calling, you call this figure cash flow before working capital changes. You all know working capital include current assets and current liabilities. So that's what we are saying. So you go analyze. For example, you take the stocks last year and the stocks this year. Maybe there was an increase in stock. You come and see an increase in stocks. If there was an increase in stock, for stock to go up, what could have happened? It is obvious, for the stock of your company to have gone up, you must have purchased some more. That is automatically an outflow. Then you go to the other component of current assets, maybe debtors. Let me assume this time there was a decrease in debtors. Maybe there was decrease in debtors, whatever it is. Now listen, for debtors to go down, maybe your debtors were 5 million last year and this year the debtors are 3 million. For debtors to go down, what could have happened? Obvious, the debtors must have paid us. This, which means we must have received from debtors. That's an inflow. Okay, listen to this now. So among the current assets, the most common one is stocks, debtors, then there is always cash and bank. Now listen, you don't analyze the cash and the bank. You don't analyze the cash. Why? Because we said it has its own specific place in the cash flow. Don't forget down there where I came and said you will add this figure we are calling opening cash and cash equivalent. Opening cash and cash equivalent. That is where you now go to the balance sheet last year and pick whatever was the closing cash last year and add it there. Then whatever you get down here should be the closing cash balance at the end of this year as per the balance sheet. So we normally don't analyze the current asset called cash. No, we don't analyze that. So among the current assets, normally you analyze the stocks and debtors. Then I've said cash and bank, it is what you put down there. Good. Now we have analyzed current assets. You analyze current liabilities also. Let me assume for now, the only current liability that we have is creditors. Maybe last year the creditors were 5 million. The creditors this year are 2 million. For creditors to go down, let us say maybe there was decrease in creditors. Decrease in creditors. For creditors to go down, of course, you must have paid them. You are paying a liability. If your liabilities are going down, you must have paid your creditors. Good. So that is it. So I'm assuming that the only current liability you have is creditors. Once you do that, get the net. Once you do that, get the net, which means you take the cash flow before working capital changes, add and minus those working capital items, get the net. Get the net of that. Once you get the net of that, we normally come and minus what we call the tax paid. So you come down here and you minus whatever you paid this year as taxes. As a company, how much did you pay as taxes this year? Listen, then whatever you now get as the net, that is the amount I was telling you, push it to the extreme. Push it to the extreme. I want to assume that you got a positive amount. I want to assume you got a positive amount, and therefore you now call it net cash inflow. You now call it net cash inflow from operating activities. Net cash inflow from operating activities. That's how we shall be determining. That's how we shall be determining the cash flows from operating activity. How did we do it? I have said, let me wrap this part so that you get it clear. We have said to get the cash flows from operating activities, we have said take the profit before tax. You will be given an income statement for the current year. So that is something you should not miss. Just go and pick it. That is a mark. Listen, that's a mark you should never miss. Profit before tax. Whatever the question will give you, it's always a free mark. Okay. Then I've said identify from the question all the non-cash items. Things that went into your income statement whereby you paid no cash or you received no cash for them. I've given a few examples. One is depreciation, loss on disposal, gain on disposal, amortization of intangible assets, finance cost, provision for bad debts, impairment, and others. Now listen. Listen carefully now. I do hope you remember from your knowledge of accounting where you did this topic, among these non-cash items, listen carefully now, among these non-cash items, two of them will never miss in any question. Any question you have ever done in cash flow, two of them will never miss. Some others will may be found in one question and not in another. Another question, you find another one, not another one. But in any question of cash flow you have ever done, two of these non-cash items will always be there. And one of them is depreciation. That is something you will always have to charge as a non-cash item. Listen, I am not saying it is a figure that is given. Some questions give the charge for the year and they tell you during the year the company depreciated the assets by 50,000 or 20,000, whatever. In some questions, you calculate it, but it is still an item that has to be there. Depreciation charge. What other non-cash item must always be there? The second one, listen, the second one that will always be there in a question is this figure we are calling finance cost. Those two should never be forgotten. That the depreciation charge and the finance cost, and in fact, listen, finance cost is something you're given. Because I've told you, you will be given the income statement for the year. It's not something you calculate. In the income statement for the current year, you will see a figure called finance cost. That's a charge for the year. Pick it. Bring it. So, depreciation and finance cost, again, we can say they are free marks. You should never forget that they will be part of the question. They will be part of the question. The others like loss on disposal, gain on disposal, amortization, impairment, provision for bad debts may be there or may not be there in other questions. Okay, good. But I've emphasized and said, don't forget about depreciation and finance cost. Those two will always be there. That is to say, whenever you're given a question on cash flow, it's like you already have 3 ticks for free. One is the profit before tax. Why should you lose it? Finance cost. Why should you lose it? It's a figure you pick. Depreciation. It could have been given to you. Okay? Why should you miss it? The others, find them from the question. Good. So now we can go to the second class. I am through with the first class of the cash flows. Now we can go to the second class of cash flows, and that's what we were calling cash flows from investing activities. Cash flows from investing activities. Cash flows from investing activities. So we want to ask ourselves, what are investing activities? What are investing activities? We said operating activities are those transactions that are used in the determination of what? Profit. Are you there? Good. But what are investing activities? Now, investing activities are those transactions that affect any transaction affecting a fixed asset, or what you can call a non-current asset. That transaction is what we classify as an investing activity. For example, if you purchase a motor vehicle, that's an investing activity. If you purchase furniture, building, that's an investing activity. So one of the investing activities is purchase of fixed assets. Whichever fixed assets your company has purchased, that is obviously an outflow. Another one could be, maybe you sold your motor vehicle, or you sold your building, or you sold furniture. That's another investing activity. It affects a fixed asset. So we come and see a sale of fixed assets. Sale of fixed assets, whichever they are, that is obviously an inflow. Good. Another example, let me put it here. I have already said, investing activities are those transactions that affect fixed assets. So suppose you go to the balance sheet last year 2020 and the balance sheet this year 2021. Among the non-current assets here, there is land, motor vehicle, building, and now we have investments. Maybe investments were 5 million last year and this year 6 million. They are among the non-current assets. So what could have happened if your investments were 5 million last year and this year the investments are 6 million? They are long-term investments. That's why they are among the non-current assets. So we are saying in such a case, therefore, we are purchasing an investment. For investments to go up, you must have purchased. So in your cash flow statement, among other investing activities, you will also have here purchase. of investments. Whatever it is, that is an outflow. Listen, it is also possible, listen carefully, it is also possible that among your current assets, you may also have investments. Though you are investing, maybe the current assets investment were 2 million and 2.5 million. You must have bought some more short term. We are saying current assets are those assets that can stay in the business for less than a year. If you have investments among the current assets, then they are short-term investments. Listen, for those such short-term investments, you don't bring them to the cash flow statement. Listen carefully. You don't bring them to the cash flow statement among the investing activities. No. As much as it's true you invested by buying short-term investments, you don't take that 500,000 to the investing activity. But the 1 million I bought as long-term investments, that one I bring it here. Next time, you will remind me, what about short-term investments? What about short-term investments? How do you treat the short-term investments when it comes to cash flows? Somebody will talk about that in a few, maybe in the next lesson when we shall be discussing more. But I do hope you know how to treat it. How do you account for short-term investments in the cash flows? I've just talked about how to account for long-term investments. These long-term investments, listen, can be by any name. Some books will call them financial assets. Some books will call it financial assets. Financial assets are also investments. Whether it's a financial asset among the current assets, here, it's a financial asset. But the question is, how do you treat financial assets that are under current assets? That is something I'm saying. You will remind me next time. For now, I'm just discussing how to treat financial assets that are among the non-current assets or among the fixed assets. For financial assets worth 5 million last year, this year 6 million, you must have purchased some investments. Okay, good. Those are the ones you put among the investing activities. Are you there? Good. Now, these same investments that you bought could have given you a return in form of dividend. So when you receive dividend income from investments, listen, those long-term investments, not short-term investments, the long-term investments. When you receive dividend from long-term investments, that should also be classified as, we can call it just here, investment income. Any investment income should be classified as an investing activity. Remember, you bought some fixed assets in the name of investments. Those are long-term investments. Those same investments give you a return. The return on those investments should be classified as an investing activity. That's another thing one should not forget. Don't take investment income as an operating item. No. Investment income should be considered as an investing activity. Why? Because it's coming from an investment you must have purchased. Okay? Good. For now, let me assume those were the only 4 investing activities in your company. 1, there was purchase of fixed assets, whichever one. 2, there was sale of fixed assets. 3, there was purchase of investments. And maybe you received some dividend in form of investment income. This is dividend received, whatever it is. Then assuming those are the only ones, get the net of all those, and whatever net you get, push it to the extreme. Let me assume now we are getting a net, and for now, I'm assuming my net is a negative amount. I'm assuming my net is a negative amount. That means you will call it net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activities. So that is our second class of cash flow. Okay, good. Now we want to go to the last category. We want to go to the last category of the cash flows now, and that is what we were calling cash flows from financing activities. We come to cash flows from financing activities now. We come to cash flows from financing activities. Good. Before we identify them, we need to ask ourselves, what are financing activities? What are financing activities? Now, financing activities are those transactions that affect finances of the company or the capital of the company. Could be, for example, last year the share capital was 5 million. This year the share capital is 8 million. For capital to go up, you must have issued some shares. One example of a financing activity is issue of shares, whatever it is. Another one could be, maybe you issued some debentures. Last year the debentures were 2 million. This year the debentures are 7 million. For debentures to have gone up, you must have raised finances by issuing debentures. So you come and say an issue of debentures. Issue of debentures, that is obviously an inflow. Maybe you also borrowed through a loan, and maybe the loan last year is 5 million, the loan this year is 3 million. For the loan to go down, you must have repaid. So another example could be loan repayment, loan repaid, whatever it is. That's another example of a financing activity. Good. Then, now let me assume for now, I'm assuming for now, those are the three major, listen, those are the three major financing activities. I'm assuming for now. And then, these financiers, whether they are shareholders, debenture holders, the loan providers, they need a return on their financing, on their investments. They have provided you. For example, shareholders have given you their money. They require a return. The return you pay to the shareholders is the dividend. So whenever you pay a return to the financiers, that return is normally classified as a financing activity. So any dividends paid is normally classified as a financing activities. Any dividends paid is classified as a financing activity. The debenture holders require a return. What is the return on them? It is the interest you pay them. The loan providers, the same. They earn interest. So you as a company, whatever you paid as interest this year, that is also considered as a financing activities. Good. So let me assume for now again that those were the only major financing activities. Those were the only major financing activities. Once you get those financing activities, get the net again for all of them. Get a net for all of them. Push whatever you get to the extreme. Push whatever you get to the extreme. Now I want to assume it's a positive amount. Now I want to assume it's a positive amount. So if it's a positive, you call it net cash inflow. Net cash inflow from financing activities. If it's a positive amount. Of course, if it's a negative, you call it net cash outflow. Now that's a positive, you call it net cash inflow from financing activities. Good. Then you get the net of all of them. Get the net of all of them. Now the three. The operating one, the investing one, and the financing. Get the total of those three figures. Get it, whatever it is. It could be a positive or it could be a negative. Let me assume it's a positive amount. If it's a positive amount, you now call it increase in cash and cash. equivalent. Increase in cash and cash equivalent, whatever it is. Then from there, you now come and add what we were calling opening cash and cash equivalent. Opening cash and cash equivalent, whatever it is. Then you now get the closing. You now get the closing cash and cash equivalent. Closing cash and cash equivalent. Good. So that's how we normally prepare our cash flow statement. I've discussed how to identify the cash flows from operating activities, of course, taking the profit, adjusting it to the non-cash item, then incorporating these working capital items, then you come and minus the tax paid, then you come to investing activities, any changes in fixed assets. I've given examples like purchase of fixed assets, sale of fixed asset, purchase of investment, and any investment income. Then from there, we have identified the financing activities. Those are the major finances of the company. That is the shares. Maybe there was an issue of shares, or there was a loan repaid, or there was an issue of debentures. Okay? Then you pay the returns to the providers of these finances. Okay? Good. So now I hope you know the general overview of how to prepare a cash flow statement. You have an overview now. Now, the other thing you should know is this. You all know that there are two methods of preparing a cash flow statement. There are two methods. Though some questions don't identify, at the lower levels, questions don't identify which method to use. But at the advanced level, the examiner may be specific and ask you to use this specific method. So, for those doing advanced level, listen, you may be required to know that there are two methods. One method is what we call the indirect method. Indirect method, which is the method I've used. The second one is what we call the direct method. The direct method. Now, for these two methods, how you present for these two methods, how you present the investing activities and the financing activities, the two methods don't change. How you present the investing and the financing, they don't change. The only difference is how you present the operating activities. The operating activities. The method I've used so far is the one we are calling the indirect method. It is the most commonly used method where you present your cash flows from operating activities using this method we are calling indirect method. Okay? Indirect method. Good. So today, I just wanted to introduce this topic of cash flow. We shall discuss it more in details in our next lesson. But today, I just wanted to introduce it. Maybe we can discuss in details how to get the direct or to prepare cash flow using the direct method. The other thing we shall do before we even complicate the topic is some of these figures may not be given to you, especially for the direct method, the non-cash items. Things like depreciation, gain or loss on disposal, provision for bad debts. Sometimes you are not given. We shall also discuss how do you calculate those items if they are not given. How much you purchase for fixed assets. For example, when it comes to investing, how much you purchase fixed asset. Sometimes the question doesn't tell you. It's your responsibility to determine how much you sold of your fixed asset. You may be told, for example, let me even give you a question. Let me give you a test. Let me give you a test. Tell me this. Suppose you are told during the year the company sold a motor vehicle costing shillings 50 million. The company sold a motor vehicle costing 50 million at a profit of 10 million. If you are given an additional information of that nature, that the company sold a motor vehicle costing 50 million at a profit of 10 million, tell me this: when you will be doing your cash flow statement among the investing activities somewhere here, you will say sale of motor vehicle. How much? When you are given an additional information like that one, and you are now required to prepare cash flow statement, tell me this: in your cash flow statement, you will say sale of motor vehicle. How much? How much will you say you sold the motor vehicle for? If you are told during the year the company sold a motor vehicle costing 50 million at a profit of 10 million, that means you sold the motor vehicle for how much? You sold the motor vehicle for how much? It means you sold the motor vehicle for how much? Yes, somebody? If you are told during the year the company sold a motor vehicle costing 50 million at a profit of 10 million, you must have sold the motor vehicle for how much? Somebody? 60. Benedict says 60. Eric says 60. Let me change. Joyce says 60. Let me change. In another sitting, the examiner tells you this. I'm changing. In another sitting, the examiner told you during the year the company sold a motor vehicle whose net book value was shillings 50 million at a profit of 10 million. For the second one, most people have said the first one, it sold for 60 here. What about for the second one? Utasema sale of motor vehicle, how much? For the second one. Now give me the answer for the second. If you are told that during the year the company sold a motor vehicle whose net book value was 50 million at a profit of 10 million, you must have sold it for how much? Eric says 50 million. Somebody else? Eric says 50 million. Somebody else? I want to hear one more opinion. Yes. One more opinion. In the second one, most of the people said 60 in the first one. What about in the second one? If you are told during the year the company sold a motor vehicle whose net book value was 50 million at a profit of 10 million. So the company must have sold the motor vehicle for how much? Yes, somebody? I'm waiting. I'm waiting. For the second one, I'm waiting for one more opinion. Somebody has said 50. Hey. Wow. Okay. Okay. Sawa. Now listen. Seems people are afraid to answer now. Now, none of you have got the right answer, whether for the first one or for the second one. I want to interpret these two statements so that you get the answer. I want to interpret these two statements. The first one says, during the year, listen, the company sold a motor vehicle costing 50 million at a profit of 10. The interpretation is this. This motor vehicle, which we are selling this year, costed us 50 million here when we were buying it many years ago. We are selling it today and making a profit of 10 million. Is it possible to know how much you sold that motor vehicle for? The answer is no. You are not able to tell how much you sold it for. Why? Because this 50 is the cost, how much it costed you 5 years ago, 2 years ago, and so on. You are selling it today and making a profit of 10 million today. So for you to know how much you sold it for, you needed to know what was the net book value of that asset as at the date of disposal. What was the value of the asset as at the date of disposal? So for first case number one here, you needed to calculate the book value of the asset at the date of disposal. So that once you calculate it, let me assume you got something like 30 million. That by the time this asset was sold, it had a book value of 30 million. Then you can now say, oh, we sold it at a time when the book value was 30, and I sold it and made a profit of 10, I must have sold it for 40 million. For me to make a profit of 10, I must have sold it for higher value than the book value. I must have sold it for 40. This second one, let me give the interpretation. We are selling an asset whose book value, net book value, is 50 million here. And we are selling it at a profit of 10 million. So for the second one, it is now possible to know how much I sold it for. Because if I sold it at a time when the book value was 50 and I made a profit of 10, then I must have sold it for 60. So it is the second one that you could tell. It is the second transaction where you could tell how much you sold the motor vehicle for. That is 60. But for the first transaction, where you are given the cost and the profit, you couldn't tell how much you sold the motor vehicle for until you calculate what we are calling the book value at the time of disposal. The book value at the time of disposal. That's what the question wanted you to know. Are you there? Good. So now I'm saying some questions may require you are given a first one where you're given cost. It means you have to calculate the book value. Somehow you have to do. So what we shall do next time, we shall look at how to calculate some of these missing items. So today, I just wanted to introduce the concept of cash flow. That's what I wanted to do, so that next time we now move on and introduce how to calculate some of the missing items. Otherwise, today I just wanted to cover the overview of how to prepare a cash flow statement. The three categories: operating, investing, and financing. Good. Now, maybe for today we can stop there. But before we stop there, let me ask you, if you have friends who are doing advanced financial reporting, tell them we have online classes for advanced financial reporting. Tell them we have online classes for advanced financial reporting. We also have online classes for financial reporting of the intermediate level. Tell them we also have financial management of the intermediate level. We're also offering financial management of the intermediate level, and we're also offering financial accounting of the foundation level and the one of ATD1 and ATD2. That is financial accounting of ATD1 and ATD2 and the one of foundation level. So those are the 4 subjects we are offering online classes for. Now, you could either join the live classes or you could also buy. If you're not able to join the live class, you can also buy what we call the pre-recorded videos for these subjects. You can also buy the pre-recorded videos for these subjects, whereby you watch the videos at your own free time, at your own pace, at your own free time, at your own pace, if you are not able to join the live class. Okay, so for those who are interested, you can reach me on this number. Let me start with the country code 254-722-658875. If you are using the country code 254-722 722-658875. Of course, if you don't want to use the country code, then it's 0722-658875. Okay, that is. Another thing is this. Before we leave, I would ask you, please subscribe to my YouTube channel. Please subscribe to my YouTube channel. It's called CPA Joseph Njuguna. That is my name, the name of the YouTube, CPA Joseph Njuguna. Go and subscribe. And also, normally the link is at the bottom. The button, the subscription button is at the bottom. You click and you subscribe. You can also like the video. You can like the video by clicking that like button, Okay, so maybe for today we can stop there. That's all I wanted to do for today. So please tell your friends, or if you are here and you are interested in one of these subjects, please call me on that number. Then we shall discuss. Either you join the live class or you can buy the pre-recorded videos. Okay, so maybe I can hear one or two comments.